million. It's increased 10% for one day. It came. That means gold is very risky investment. If you solely invest in gold and you look at gold in the one comes in the standalone risk. However, if now on your portfolio you have USD, you have some currency here, and you see, look at about the level of risk of gold. If you push gold in the portfolio here, actually this one have you to reduce the volatility of that portfolio. The reason why, because gold and USD move in the opposite direction. If you this one fluctuates so much and indicate that you lose money in USD. On the other hand, you can earn on gold. On the other hand, if you earn on USD, you may lose on gold. However, when you combine, it means that on average, you can estimate the return you earn. And the outcomes happen can far away, but not so much because the level of risk, the volatility is low. That's here explain to you why for one asset, we look at the level of risk. We don't look at this one standalone. We look at in the context of the portfolio here. Gold is one example. If it's standalone, very risky. But when you compare with this one, gold is considered as the safe investment. And link to the gold. Except you. If you invest gold for long term, yes, it is safe investment. But if you consider gold as a short-term investment, it is extremely risky. Again, go back to investment horizon for you to set up, and you will see about that investment and make decision that should you invest or not. Here, this is about the way to measure for the risk of individual security. I just remark quickly, and I think that's all of you have already known. Okay. And again, whenever I go so fast or I pass some part, but you want me to discuss that part, just tell me. And here, when we combine two assets, you will see the more important factor that contribute to the portfolio risk about this one, the relationship between two assets. We call correlation coefficient. And this is the portfolio variance. It determines by two items. The first one you see, it depends on the individual asset risk, which is here, the standard deviation of bond, the standard deviation of stock. And another factor that contributes to portfolio risk, which is we call the correlation coefficient, or we say this is the relationship between two assets here, bond and stock. And you see correlation coefficient is ranged from -1 to 1. And look at here, of course, we refer this one as -1 because it's negative and it will have to reduce significantly the level of risk for the portfolio. In case that this is, but in practice, there is rarely the for two stock that move opposite direction and perfectly here. No, really rarely to see. And in practice, actually, we see this one much more here, mean though security or your assets move in the same direction, but also not perfect. And for this one, we still combine and we reduce the risk because as long as this one less than 1, and here we push on that one, it's still less than, like for example, just two assets combined together. This one. And I think this is a review, so I don't want to do that again. But the main purpose here, we really want those assets move in the opposite direction. So that's we got this one negative here. This one contribute to negative. And consequently, it reduces significant level of risk. However, in practice, we see in stock exchange, almost of stock moves in the same direction. When moves the same direction, it means that correlation coefficient between two is larger than 0. However, as long as this one less than 1, you can combine and you reduce the risk because it's less than 1. So here, it's sometimes here plus, but less than just simply 2 assets. Like this one, you less than 1. I'm sorry, but just because whenever I want to talk, I will try to talk until at the end. So here, less than 1. And though this one will less than, I'm sorry, do you want me to do this again for this term? It means as long as the correlation coefficient between two assets is less than 1, you combine and you can reduce the risk. I just want to ask you because maybe you think that is unnecessary, so I bypass. But if you really want to discuss it, I'm very happy to do that. Now, tell me. Could you please tell me here that you said that that's okay? You have already understood clearly before, so we can just review and discuss together, and we can go further. Or you really want me to review that part again for you to got the full understanding? Just tell me. Chapter 1. Today review, so it depends. We have the opposition. Okay. You can keep. But one student require again. So I think, okay. 1 minute again. Here, object correlation coefficient between two assets here, positive, as long as it's less than 1 here. You see? But on this one, we can extend more. We can check this one. Sorry, I will try to say here. Correlation here, we are discussing as long as it's less than 1. Is that right? When we combine, can we reduce the risk? And we check from this one, we will multiply for both two equations and keep that one. See like this. And we check here. Now we multiply the weight, the standard deviation, the standard deviation. Similarly, for this one, we keep this one as a 1 before, and again you multiply for number 2 here, the weight, the standard deviation, the weight, the standard deviation, and correlation here, 1 as a 1. And similarly, another as we plot this one, the sign of equation unchanged because all are positive. We just add this. And we add another one here. Similarly, we add for the right hand side of the equation. Okay, we have that. And now have a look. This is tells you about the formula to calculate the variance of portfolio. This one, of two assets. And it tells you that it's less than. And less than what? If you consider this one at the A, this one at the B, and here you can write like this: 2 plus A and B. And it reminds you that from that equation, we can rewrite again as a here, A plus B power 2. And you see, A plus B now we write again the weight we invest in assets A, the standard deviation of assets A, the weight we invest in asset B, and the weight we invest the standard deviation of asset B. Power 2. And do you agree with me? This is the average, is right? Average risk of two assets. This is the individual, the level of risk of assets A. This is the level of risk of assets B, which are measured in terms of the standard deviation. And the weight we invest in each asset, the weight we invest in each asset, is right? So it means this is the average level of risk of two assets. And here, this is the portfolio risk. And you see, as long as this one is less than 1, it means as long as two assets move in the same direction, but not perfectly, we combine. When we combine, we can generate the portfolio that's got the level of risk, which is also less than on average risk of 2. So that explains to you here, it shows you about the benefits. The benefits when you combine two assets in the portfolio. At the end of the day, you will have the portfolio risk here, measured by this one. And this level of risk is actually less than on average, less than the average risk of two assets. So it's better if we combine together. And here, the level of risk you facing now less than average of two assets. If so, that's one. And now you can see in case that is not, it's perfectly, you see, it means that A and B are perfectly related, equal. You will see for this one, we have equal. And for the portfolio level of risk, it's equal. It means, though, it means the portfolio risk here, after combining two assets, just about the average risk of two assets, and you cannot reduce. If you invest more on assets A, yes, you take more risk. And here, if you remember that, we got this here. For the correlation coefficient between two assets equal to 1. And you cannot reduce the risk. If you invest more in assets A, take more risk. Less in assets A, take less risk. The level of risk for the portfolio is just about the average, like you see here, the average level of risk of two assets when you combine together. So for this case, we say that we cannot reduce the risk. It's just like the similar average level of risk of two assets. However, as long as two assets, yes, move in the same direction, but not perfectly related. So that's why we have this one, okay? And at the end, when we combine, yes, it's less than on average. That's why you see here, we have the line like this. And for this one, suppose the correlation coefficient between two assets is 0.2, for example. When you combine, you see, we see that's one. for the same level of risk here. When you combine, you can reduce the level of risk. This is tell you about the average level of risk of two assets here. That's point. The average mean you invest in asset A here, or you invest in asset B, and it's based on the weight you allocate between A and D. It will move in declines. This is for average level of risk of two assets. However, like we see, as long as the correlation coefficient between two assets less than 1, it means, okay, now we combine together, and this is the level of risk. Based on the formula here, we have the level of risk of the portfolio. And this is, yes, it's less than average risk of two assets, like we see here. So that's why the conclusion is whenever the correlation coefficient of two assets is less than 1, you have a way to combine your assets and reduce the risk. You still earn the same return, but now you face with a lower level of risk. Okay, and this is for the portfolio theory. The main points of the portfolio theory here, this one, and it shows that, okay, like this, it's reduced, and that point here less than the average level of risk of two assets. From that point of two assets, we stand for portfolio of many assets. If you remember that in the matrix, it's right. We invest in many assets. Before we explained for two, and now we stand for the portfolios of many assets. Here, this is the way to calculate about the portfolio variance. And the way to calculate, like you see here, weight. And the standard deviation with correlation coefficient between A and A. And the correlation coefficient between A and A is equal to 1. That's why you can eliminate this, because it's equal to 1. Similarly, you see for B here, we can follow this one, weight of B, the standard deviation of asset B, the standard deviation of asset B. Correlation coefficient between A and B is equal to 1, so we can eliminate. Similarly, we look at for C, the weight we invest in asset C, the standard deviation in asset C, the standard deviation in asset C. Similarly, for D, okay, and for other, you see, for other item, we check at the weight of asset A, the weight of asset B. But here, some here, and we have correlation coefficient between A and B. This one similar, we have here correlation coefficient between A and C, correlation coefficient between A and D. For this one, because it's different from 1, so we cannot eliminate. That's why it's acid. Similarly, you will see here, correlation coefficient between A and B. That explains to you why in the portfolio variance, we classify into two items. This one, you see, it depends on individual asset risk. It reflects for you about the individual asset risk with the standard deviation of asset A, the standard deviation of asset B, etc. And the rest of the portfolios, it reflects about the relationship among those assets here. Okay, that is why we divide the portfolio risk into two items. The first one, it depends on individual asset risk. And another one, it depends on the relationship among those assets. Both contribute to the portfolio variance, or we can say portfolio risk. And here, have a look. This is the example for you to see about the portfolio of 4 assets. With the portfolio of 4 assets here, 4 assets, you will see, we classify and we see we have 1, 2, 3, 4. 4 items. That's right. Major individual asset grades. And we have actually the rest for the portfolio of 4 assets. We have 16 components here. I will call 16 items. And among 16 items, we have 4 items like you see, 1, 2, 3, 4, reflect individual assets, and the rest 12 reflect the relationship among the assets. Rather than we invest for 4 assets, we can stand for 10 assets, the portfolio of 10 assets. And now with the 10 assets, we have the magic here. 10 multiplied by 10, it means that's 100 items. And among 100 items here, you see how many items reflect the individual asset risk. Please tell me how many items. If we have the portfolio of 10 assets, how many items reflect the individual asset risk? Yes, exactly. We have 10, is right? And how many items reflect the relationship among the assets? 90. You're right, exactly. Thank you very much. We have 90. Did you see? And now, suppose I invest in the portfolio that's got 30 assets. So it means that how many items in the portfolio variance here? If I invest in 30 assets, how many here? How many items? 30 multiplied by 30, so we have 900. That's right. 900 items in the matrix of 30 assets. And among 900 items, how many reflects individual asset risk? How many? Exactly. Thank you very much. We have here 30 and we have here 870. That explains to you why they mentioned that when we increase the number of stocks, the individual asset risk, or we call Dow risk, come from firm-specific factor, reduce significantly. It reduces, or even though we can eliminate, if we compare 30 over 870. Okay. Again, for this one, we mentioned that when we increase the number of stocks, the individual asset risk is now placed less and less important. And we focus much more on the relationship among those assets. That's why we care much more about that. It contributes more. Okay. It contributes more. So that's why it's explained to you. We don't care about the individual asset risk in the context of portfolio. In the context of portfolio, what we care? We care about those assets here when we put in the portfolio, how it's related to other assets in the portfolio. That's why, based on that, we can grow with some portfolio here. And actually, you can determine many portfolio here. Like for the same return, you can set up many portfolio. Yep. And we choose those portfolio that generate the lowest level here. We call this the optimal one. Similarly, for the same return here, we can generate many assets. But portfolio A generate the lowest level of risk. There is no portfolio asset. That's why we say portfolio A is optimal portfolio. Similarly, to the assets to B, we can generate many portfolio that generate the same return with portfolio B. But portfolio B is the optimal one because no one better than that when portfolio B generate the lowest level of risk here. And we see A and B are optimal portfolio. Portfolio C is not optional. That's why we don't choose. And now we choose A or B. It's up to you. If you are strongly risk averse, you make decision and you combine between risk and return. It makes the utility is better and maximum at that level. So you choose. Another one, other investor, if they want to earn more money, you earn money quickly. So they may choose B. But A or B are good equally. This one for portfolio theory. First, it tells us about the relationship, the role of the relationship among two assets. How should we invest in portfolio? Because it helps us to reduce the risk. On the other hand, though factors contribute to portfolio risk, we focus much more on the relationship among two assets. Okay, this is for portfolio theory. And you see the efficient function here. For portfolio theory, we don't have the risk-free here. We don't have. That's why we only have the risky portfolio here. Risky investment, or we combine our risky assets with those stocks, the bond, whatever. But after that, we will choose the best optimal, the best portfolio. Okay. This one just some idea. And similarly, you see when we increase the number of stocks, the individual grades, or we say though grades linked to the firm specific factor will reduce significantly. Okay. But on the other hand, we have some kind of grades that we cannot avoid because it affects the whole system. Okay, it affects the whole system. We call systematic risk. This one I strongly believe that you know already. Okay. And from the portfolio theory, we extend to market theory. For the market theory, you see here, we have this one, the new investment, we call risk-free investment. Because this is the risk-free, so you see there is no change, no fluctuation, no volatility. So the standard deviation is 0. But we still earn the return. If you study in MCAS, you know about that. The reason why we require to earn money, to earn the return on our money. First of all, when you invest money today, it means you have already sacrificed to enjoy the life. But you sacrifice for what? To receive more in the future. That's why it determines for you about the pure return. Even though you face no grace, even though no inflation, but in finance, just mean when you postpone to consume today, it means you sacrifice something today, but of course, for what? For consume more in the future, for got more money in the future. So you actually compensated. As a result, you always got the return here. Yeah. And even though no risk, even though no information, but investor they always the return. We call this is the pure return. Okay? And you face no risk, so you can call this is the risk-free rate. For the risk-free rate, now we can consider that now we have two assets. One about the portfolio. It can be portfolio A, it can be portfolio B, C, whatever. And another one we have here, risk-free investment, such as government bond can be the good example for the risk-free investment. Okay, and we have here risk-free. Now we will think that's when we got the new assets, we will combine. This means that we add the risk-free in the portfolio. You can invest in portfolio A and you add the risk-free in portfolio A, or you can invest in portfolio B and you can add the risk-free on your portfolio B. At the end, at the end of the day, sorry, actually now we come up with a new portfolio. And the new portfolio is include 2 assets. You can consider that portfolio A as the 1 asset and and asset 1 is a portfolio A, asset 2 is a risk-free investment. And when you combine 2, you go back to the portfolio of 2 assets. Okay, and you apply the formula to calculate the portfolio of 2 assets. Okay. And have a look what occurred. It's not called here, so I will write it. Here, I remember that we have that formula to calculate the portfolio variance, which equal to asset A, asset 1, the standard deviation of asset 1, this one, power 2. Asset 2, the standard deviation of asset 2, this one. Asset 1, 2, 2, and correlation coefficient between assets 1 and 2. We apply this one for the new portfolio when you combine the risk-free with any portfolio. And we will see, based on that, we have the portfolio variance which equal to, I suppose I replace assets 1 as the portfolio A. Asset 2 at the risk-free. This one, assets A and the risk-free. So now we have the new portfolio and have a look. This is the risk-free, right? As a result, the standard deviation of the risk-free investment is 0. That's why we can eliminate this item. The correlation coefficient between 2 assets here means the portfolio A's can go up, go down, go up, go down, but the risk-free just stands because there is no volatility in the risk-free assets. You earn exactly that return, nothing changed. That's the result. There is no correlation coefficient between portfolio A's and risk-free. As a result, this one equal to 0, and you can eliminate that. At the end of the day, finally, we got the new portfolio variance, which equal to what we invest in the portfolio A and the standard deviation of the portfolio A. And we come up with this one. And now you see, because now we have the linear relationship. We don't have power 2 here. That's why when you grow the efficient frontier, this is become the straight line, not the curve. Okay. When you got here, the return and the standard deviation, and you got the return here. It's based on the weight you invest in portfolio A and the return you can earn on portfolio A. This is the weight you invest in risk-free. This is the return you earn on risk-free. And you see, we calculate and we choose the item here. You can grow the straight line. The more and more important here, the standard deviation, you see, before, based on the formula, we have some power 2 here. It means that the relationship become the curve. The relationship between growth and returns is the curve. However, when we got the risk-free assets, we combine, we include in the portfolio. Here, it's become the linear relationship. That explains to you why from portfolio theory, we have the curve. Now, when we include the risk-free, we got the straight line here. And they say that's when we combine, for example, if you combine the asset C with the risk-free, this is the straight line, reflect the combination between risk-free assets and portfolio C. And you see here, the combination between the risk-free assets and portfolio B. And this is the combination between the risk-free assets and portfolio A here. And you remember that before we discussed that portfolio A or portfolio B, they are good equally because they are lies in the efficient frontier. At that return, no portfolio can generate the lower level of risk than portfolio A. Okay, so that's why you choose A or B, it doesn't matter. However, now you see, if you choose to combine with the risk-free assets here, you will see the difference. This lies in the combination between risk-free and portfolio B. This lies in the combination between the risk-free and portfolio A. And you see, actually, all of us will move from portfolio B to portfolio A because this line generates the steeper line. It means you can see the same level of risk here. The combination between portfolio B and risk-free generates that return. But the combination between assets A and risk-free will generate a higher return. As a result, rather than combining B with the risk-free, we will move to choose portfolio A. And now, between A and M, yes, all of us will move to choose portfolio M. And you see, for this point, all investors choose to combine between M and risk-free assets. As a result, when all investors want to invest in that and they invest, portfolio M becomes a market portfolio. And this is the market portfolio. So you see, and don't worry, even though you like risk or you don't like risk, all of us still choose portfolio M to invest, because if we choose A, B here or A here, it's not good. And all of us will choose to invest in that portfolio M. And now the next step here, think about that. Okay, we invest, but how many percentage should we invest in market portfolio? This is the second question. The first question, choose portfolio to combine. And we rather than choose B, rather than choose A, all of us choose M. That's it. That explains to you why in the market we have the market portfolio. And for example here, this is for portfolio A, okay? And this is for portfolio M. You will have those assets here. And you see, because no one choose to invest in portfolio A, as a result, no one trade those assets. Thus, do not belong to portfolio M. And those assets here will disappear in the market. And at the end of the day, only those assets investors they choose to invest exist in the markets. It also explains to you why for the portfolio M, we call this a market portfolio. Because here now, A and M, but they only choose to invest in portfolio M. It includes some assets here. Yeah. And before, there is no risk-free, some assets will include some investor. They choose portfolio A. That means here, there is some assets here. And after that, this one. But now when they move to choose M, it means some assets included in portfolio M, yes, they are traded in the markets because investors, they want to invest. When they want to invest, they will buy. It means it's exists in the markets. Though here, assets here also exist in the market. But here, from now, portfolio A disappear. Some assets that do not belong to portfolio also disappear because no one keep, no one hold, no one wants to buy, disappear. Explain to you again for this term, market portfolio, it means it includes those assets that investors they want to invest. Or we can look at the moment, those assets are traded in the market. When it trades in the market, it means yes, investors they want to keep, and it create a market portfolio here. And from that point, now the second question, think about how much we invest in portfolio M. It depends. Portfolio M is a risky investment. So it depends. If you are strongly risk averse, you don't want to put so much money on portfolio M, even though you still invest, but you don't put much money. You just put around 20% for portfolio M, and the rest, 80%, you put in risk-free. That's why your portfolio is quite here. Okay, and when you invest 80% in the risk-free investment, it means you invest in government bond, you lend money to the government. That explains to you why, as long as you invest in risk-free, we call this the lending, because you lend money to the government. And in the markets as well, some investors, they not just invest 100% of their money in the risky portfolio, but they still borrow more. Right? Suppose they got 100 million, they will invest in market portfolio. On the other hand, they borrow more at 20 million to invest in portfolio, and again, in total, they invest 120 million. Over 100 million that they have. It means that they invest more than 100% of their money. Where's money come from? They must borrow. Otherwise, where money come from? That explains to you why later on, one, you invest more than 100% in the portfolio, and it means that you need to borrow money, and we'll call this one borrowing. So from the portfolio theory, we don't have the risk-free, we got this one. Now when we have the risk-free, everything changes, and we come up with at the end of the day, all of us agree that the market portfolio is the best choice, and we invest. In practice, of course, for some investors, they don't invest in market portfolio, it's right, but it's up to them. And here, you see, the second one depends on the risk preference. They will allocate the money between the risk-free and market portfolio. Okay. This one. And here, because we invest in market portfolio, it means that we invest in many assets. And suppose many assets here, and if those kind of risk come from specific factor of firm, it makes that stock increase. But for other stock, and that's affected by individual, is right. That's why you see for this one, but just for a few days, in almost a day, they will move with the market, and it links to the macro factor. Why? Because when macro factor occur, it will affect all stock in the market. That's right. So it's moved together. That is why here the standard deviation measure about the total volatility, how stock price movement, and the stock price movement is includes two aspects. One comes from the individual asset risk. One comes from the specific factor of firms, and another one comes from the macro factor. But when we look at how its relative moves to the market, like for example, this one, this is the market, and we see for this one, like this, okay, when the stock price increase, okay, it's got two factors. One comes from the market, so it's increased because of the market increase, and don't occur when macro factor happen. It affects all markets as a whole, and at that time, it affects the individual stock. And on the other hand, some here increase more because the specific factor of that firm. That is plenty one. We see we don't take the standard deviation, which includes all volatility. We just want to measure when the markets move here, how the stock move. When the markets move here, how this one move. As explained to you why we take the beta at the measure of risk, because the beta measure the relationship between two risks. One, the market. And another one, individual stock. And of course, in some day, that stock move and the market does not move. But when we take the regression, we consider almost of days when the stock move with the market just come from the macro factors, because macro factor affect all. And here, beta tell you about the relationship with the market. And now why we change from the standard deviation to the beta? Because remember before, we end of the day with the market portfolio. Mean we will invest in many assets, not just one or two, many assets. And at the end of the day, we come up with the relationship among those assets is more and more important. And the relationship means for something happen, how it's related to that one. This one moves stronger compared with this. This one moves stronger compared with this one. Yes. So at the end of the day, one, we invest in many assets. The level of risk of this one depends on how it's linked to other. And here, when we invest in the markets as a whole, it means we concern how it's linked to the markets as a whole. Okay? That explains to you why we come up with the beta. And the beta here tells you about the level of risk. Level of risk here measured by the systematic risk, because we refer to see from the context of the portfolio here, the context of the market portfolio. When we consider the level of risk of one asset, how it's moved relative to other. This means how it's linked to other. We come up with this one. And we have the model, CAPM. It tells you about the relative level of risk of one asset compared to the market. It will help us to determine about the return we require to earn. Okay? This is the formula for the standard deviation. So we come up with this one. Here, I think we can bypass for over or underprice. And based on that, we invest and we earn. So now we think about the strategy. First of all, if we invest in the stock with the beta here, we will determine about the return we require. So we can say that expected return, the return we require to earn. It determines by this one. Okay. However, the actual return we earn here, the actual return we earn, it can be larger than what we expect, or it can be lower, whatever, or it can be equal. Okay. Now, what you want? Think about that. Suppose if you want the return you earn equal to what you require, and it determines by the level of risk you take, you can apply the passive strategy. Because for the passive strategy, it helps you to earn the return. But normally, this is normal. Normal return means how much risk you take, you can earn the return at a certain level of risk you take. And for the passive, it means you buy and you hold. You don't trade stock so frequently. Okay, no. So that's why we have here equity portfolio strategy. On the other hand, if you want to earn the return, which is a little bit higher, it means, okay, you accept that level of risk you take, but you want to earn the return higher than the level of risk you take, you may trade actively. Actively means you buy and sell frequently. And it depends on what you believe in the market. If you believe that the market is efficient, okay, if the market is efficient, remember, always we invest, we require to earn the return. But the return we earn is just normal. Okay. the return we earn is normal. Okay, just the normal return. Normal return. So if you can earn normal return, think about that. We may waste of time to trade actively because to earn abnormal return, the market should be inefficient. When the market is inefficient here, you believe that those stocks can be under or overvalued. You see, and because the market is inefficient, some investor they got the information, but some investor they don't have, or the information is not transparent. Some investor they got the right information, but some investor they don't have the right and enough information. As a result, they will come up in the market and they will have the different perspective for that stock. Sometimes because they don't have enough information, so they think about that the stock is cheaper, so they sell at a cheaper price compared to the intrinsic value of that stock. It is explain to you why, if the market is not efficient, we think about that. What does it mean about the stock market efficiencies? You see, whenever you invest, what you care about the information. For example, here, even though at the moment, the world economy is still in crisis and have not covered, but why the stock markets go up? S&P went up, VN index went up, even though at the moment there is no, it's right, the number, the figure told us that, okay, the world economy is now recovered already. However, we invest today for future. That's why we look the information, and based on the information, we forecast, we estimate for the future. And when we forecast, we have to base on information. We have to base on the information. Is that right? Like now we got the good news for the vaccine. We got about the quite good news for the American president election. As a result, people, they estimate about the future. The second point, where we base on, we have to base on the information we receive. Okay, that's why when we talk about the efficiency of the stock market, we think about the way that investors they receive information. The information is transparent or not. The information is spread quickly and freely to investor or not. This one item. Okay. Here, I would like to combine two lectures about the strategy and about the efficiency, because based on that we deal with the strategy. So in here, like you see, first of all, when we talk about the efficiency of the market, we need to think about two items. The first one, information. Because we invest in stock, finally, we base on information to analyze, okay, to estimate the information. For the information, we think about that, how it spreads to investor. If it's transparent, it's right, it's good, and it spreads freely, it's better than investor have to pay. Because whenever investor have to pay money for information, it means that the rich investor, they got the advantage compared with other investor. So that's really. and also correctly as well, or not, or unbiased. Okay, this one. A second factor is about the how investor they react to those information. Here, I made this here. The information. We talk about the unbiased. Okay, and less costly, or we can say that free. How information spreads to investor is unbiasedly and free. And another one, how investor they react or they receive the information. If investor they receive unbiased and free information, but investor they are so crazy. Okay, they're so crazy, so they make the stock price move unpredictably. It means that it's not good. Investor they can overreact or underreact. Okay, it means from information. When we talk about the efficiency of the market, think about two aspects. The first one, the information, how it spreads. It must be spread unbiasedly and freely. And the second one, think about the investor, how they use that information. If investor they use that information, but they overreact, it means the stock price now overpriced, and next time markets have to adjust again. It means the market is not efficient. Okay, we say here not. And in case of that one, the return we earn is just normal return. Okay, not abnormal anymore. And you see, that's why we think about that the stock price is price fairly. When the stock price is price fairly, so just take high risk if you want to earn high return. If you don't want to take high risk, accept to earn low return. This is for the efficiency of the market. Okay, and now it depends, and that's why it's affect the strategy you apply. It comes from your belief. If you believe that the market is not efficient, if you believe that the market is not efficient, so this is the chance for you to take low risk, but you still earn high return. That's we call abnormal return. And how you can do that? First, you can focus on the information, like you take advantage to receive more correct information, and you receive the information earlier than other investor. Okay. On the other hand, you may observe the market, how investors they react. If they overreact, you should go in the opposite direction with the markets, because later on markets will come down and markets will adjust the stock price. That's why you think when you set up the strategy, first of all, keep in mind that look the market, think about the efficiency of the market. Okay, if the market you think that is not efficiency, that explains to you why for the strategy, passive or active, it depends on your belief. Your belief. If you believe that the market is not efficiency, try to dig on that information. Try to find the inside information. For example, that's earlier than other investors know. Okay, try to dig on that. On the other hand, observe the markets and see about the characteristics of the markets. If the markets overreact, you got to go opposite side. Like when they bought a lot, you may sell. On the other hand, here you move in the same, but you take advantage. This is just in general. explain for you. And you see, when you try to dig on that, it means you should invest in active. You should employ the active strategy. Okay? If you believe that the market is not efficient, and invested here, and based on that one, it tells you some here, overvalue or overpriced. And this one provides you the chance to find out the undervalued stock. I'm sorry. Here, undervalued stock. And you have to trade actively to look for that. That's right. If you want to earn abnormal return from the belief here, and you should look to find. Here, this is the characteristic of the market. It provides the chance for you to do that. And that's explained. Go back to the strategy. When you see the opportunities, you need to act quickly. It means you have to trade actively. Don't just buy and hold and wait. That's right. So the strategy now depends on your belief, what you observe, what you think about the market. On the other hand, if the market is efficient, okay, if it's efficient, so you see, sorry, this one, no, so when the market is efficient, so investor again, they do not over or underreact. It means that you don't have chance to find under or overvalue. And if you don't have chance to do that, the information is unbiased and freely. It means, what is the better way? You should trade passively. You should trade passively. The reason why, because we trade actively for what? To find under and overvalued stock. But if we believe that there is no chance to find over or undervalued stock, we should trade passively first, at least to reduce the transaction cost. It's right to reduce the transaction cost. And even though you know, but you don't have the superior information here. You just have the normal information. You just have the information like all the investors they have. Where is the advantage? You don't have advantage, competitive advantage. So that's why you should trade passively to reduce the risk. Only in case that you have superior information here, okay, you trade actively. Or on the other hand, investor, they buy stock unfair, is it? Some under or overreact. Okay, trade actively. Otherwise, two conditions. One, if you don't have superior information, it means even though markets is not efficient, but if you don't have superior information, it's better for you to buy and hold, actually to reduce the transaction cost. Okay, or if the market is actually truly efficient, just waste of time when you try to earn abnormal return. So that's why for the third question, you think about the Vietnamese stock exchange, think about the strategy when you apply. Think about that. You should invest passive or active. It depends. Even though Vietnamese stock exchange can be inefficient, but go back to ask your answer to question. Do you have the superior information? If no, how you can beat the market? That's right. Again, you can think about the long-term or short-term investment to invest. And we continue to discuss here. For the in case that's okay, you want to trade actively. Now, Think about that. For the activity, you can apply fundamentally, you can apply technically. It's up to you. Okay. And here again, it depends. The way you invest now depends on the characteristics of the markets again. So that's why I refer to combine two lectures to discuss about the strategy. Okay. And you can see here, when we talk about the information, the efficiency is right. We talk about the information. And you build the strategy depends on the information that you have and depends on the characteristics of the market. If on your hand, you have the stock price movement, you have the trading volume. Think about that. Can you use it? Can. And when you use it, it helps you to do what? It helps you to grow the charts here. Okay. And suppose based on the charts. Now think about this. The stock price movement in the past does have you to predict in the future or not. If you say yes, okay, use it. It means you apply the technical analysis and you invest. Why we talk about the technical? Because you see here, we don't care about the performance. We don't care about the industry which that company belong to. We really don't care about that. We just focus on the stock price movement. And for the technical analysis, all reflects in the stock price already. So that's why we don't have to care for other. We just focus on the stock price movement. Okay. And here, if the stock price movement in the past can have or to predict in the future, okay, use it to beat the market to earn abnormal return. And it means you see, suppose tomorrow the information is not good, I mean the bad news, reasonably, it's right, the stock price should go down because of the bad news. However, because the market is not efficient. When the market is not efficient, it means regardless about the bad news coming, the stock price continue to goes up. And you see, it means yes, the market is not efficient anymore. That's right. That's why the market is not efficient for this case. And for this case, yes, stock price is useful. You use it to predict the stock price movement for the next times, and you take advantage by predict the direction of the stock price, and you earn very high return, abnormal return. This one. And for this, we call market is not efficient. You see, for this, even though the best is coming, but the stock price does not reflect, does not adjust based on the information coming inside. It just followed the trend in the past, and market is not efficient. However, you see, in this case, if market is efficient, it means that the stock price will predict the information coming. Yeah, information coming, and the stock price rather than at your predict must is go down. And for the news here, actually just is released, we know, but if before we don't know that it's good, we don't know it's bad, we don't know, or even don't know information. That's explained to you why for what happened in the future, we really don't know if the market is efficient. Market is efficient, information come tomorrow, it can be good, bad, or no information come. As a result, the stock price, it can go down if the information is bad, it can go up if the information is good, or it's unchanged It means that we cannot predict. When we cannot predict, don't use it anymore to predict. Okay? And this one is usefulness. With inflation, we say no. We don't use technical analysis. And when you cannot use the stock price to earn abnormal return, think of another information that you can use to an abnormal return. And we have another information, like we have the return on asset, return on equity, we have the ownership. We have another one about the CEO. We have the strategy. We have the M&A information when the company announced. We have the stock list, manufacturing. And those here based on those information. Okay. And now, again, those information are public, available to everyone. If the market is efficient, you see, if efficient, it means that all investors, they use all public information to price the stock, and it's priced fairly because they are smart and they use all information, they determine the price. When the price is like this, it means that now you see no under or overvalued stock. What you focus, we should focus to earn normal return. That's all. The normal return, no more. Okay. But if the market is not efficient, you will see if it's not efficient, it means even though those information here are available to our investor, but they cannot use those information to price the stock fairly. Okay. That means some stocks are over or under price. Or sometimes markets over or underreact. And you see, with those public information, but investors, they don't use all public information here to price fairly. Some over under stock exists. That's why it provides for you the chance to use those information here to earn abnormal return. And to do that, based on those here, you can build many strategies. Like if you base on the size of the company, you can set up the strategy, which means you only invest in small company, for example. Or if you base on the M&A transaction, you may focus on target company, for example. Or if you base on the PE ratio, you may build a strategy with a low PE ratio. Whatever, still have a lot. Or you just invest in those stock that's allowed to split the stock. Or sometimes those companies face with a financial crisis or financial distress. Whatever. Okay. Or the ownership. With the ownership, you may just invest in state-owned company, for example. It means now you can base on those public information to set up the style that you invest. So we call this the style investment. You can set up on that. If the market is not efficient, don't need to look for all the information. You can use it. You can use the public information here to earn abnormal return, because in the market it exists over and undervalued stock. And based on the public information you have, you can set up the style that you invest. Like you refer to invest in small stock. Okay, we call this the style investment. Or you refer to invest in low PE ratio, or you just focus on the target companies in M&A transaction. Or if you pick ownership, you think we have state-owned, we have the family-owned, we have the financial institution. So you may choose one. It creates your investment style and all information they have, but you can earn abnormal return because the stock price is unfair. Okay, and you got chance to earn on that. It means we discuss about the stock price is not efficient, and we classify for 3 level here. We call this one is weak, because the information you have is just about the market information. And another one, because though public information available to investor but not private, that's why it is strong but not really strong. So we call this one is semi strong. Okay, and now it depends. What you think. If you think that the market is not efficient in that form, use those information here enough for you to earn abnormal return. Okay, like you say, I remember here, if you believe that the market is not efficient in forms of quick form, okay, don't need to look other. Just use those information here. It can help you to earn abnormal return, because for this case, the market is easy to predict. Okay? Even though we have the best new information coming, easy to predict. The second one, if the market is not efficient in forms of semi-strong form, okay, don't need to look for private information. Just use all public information here. It can help you to earn abnormal return. The reason why, because the market is not efficient, and people, even though they got public information, but they don't use it efficiently to buy the stock fairly. As a result, some over and undervalued stock, you use it to earn abnormal return. And now the story changes a little bit here. If the market is efficient, you see, in forms of semi-strong form, it's efficient, mean all information here investors use and they buy the stock fairly. When they buy the stock fairly, no over or undervalued stock anymore. And it means you cannot use those information here to earn abnormal return. It means that those strategy here, no, it's just waste of time, because the stock price fairly should not set up investment style. It helps you nothing. No. And what's the bad thing? Please, rather than use this one to beat the market, should use this one to invest in the portfolio. So it means you should diversify to earn normal return. But this one, because the public information here are already used to buy the stock fairly, no under or overstock anymore. When no under or overstock anymore, so is it better if we diversify to reduce the risk? Okay, and if you still want to earn abnormal return, okay, for this one, cannot use it because all people use it already. You need to move to look for the private information. And for this case, actually, we don't find under or overvalued stock, but we take advantage. We act quickly. Like for example, this one. You see, in day 0, this is the day that information is released. And suppose this is the good news and the stock will react at that level. But when you got the private information, mean you know the information before it's released. You know about that, and you can buy stock 5 days before it's released at a low price. After 5 days, when the market adjusts quickly and unbiased, it's go up to that one, and you can earn the huge profit. It means you need to look for private information. If you still want to earn the abnormal return, and the markets now are very efficient, but again, because it's efficient but not perfectly, that's why we call for this level just about semi-strong form. And when it's efficient in form of semi-strong form here, okay, the information here I use already and brother software. We have to look for other kinds of information we call private. For the private information here, this is the case for you. The stock is not under or overpriced, no, but it means you take advantage of knowing information before market know, and it means you can buy at a lower price before market receive the good information and it adjusts for the stock price. And in case that the market is also efficient in forms of strong form, mean no private here. This one everyone know already, so it means that exactly the day that inside investor know, public also know. It means no chance anymore for you to earn abnormal return, just earn normal return. Okay. So this is I want to ask you that think about that. When I provide you some characteristic of the markets. Think about that. Can you earn abnormal return or not? And if you want to earn abnormal return, which strategy you may apply? Okay. And we go back to see here. That's it. I combine so maybe a little bit confused what it means. Active or passive strategy based on the belief of the market. And based on the characteristics of the market, you can set up the range of investment strategy so that can have you to earn abnormal return. Like we discussed before, and we apply fundamental, we apply technical analysis to earn abnormal return. And here, which one we use, it depends on the characteristics of the market. Okay? And here, some just like I suggest for you about the active strategy, anomalies just mean that something we observe but we don't know how to explain, particularly for some weekend or January effect. It means during the day they don't know, but they found that the stock price as weekend a little bit higher than other days, or the stock price in January higher than for other months. This occur for America. In Vietnam, we have some sensitive periods which is close to test holiday. It's not exactly January, but similar to American stock market. And here, Chito here, you read that one. I think nothing to discuss much on that. And now we come up with the last one about the evaluation. Okay. I will to ask you that I know that is a very boring lecture and I talk a lot. But because we have to review all things and this may make you confused. Now, stop here. Ask me those questions if you have. First, any question that you have? You will see, actually we have two topics. One about market efficiency and another one about the stock equity portfolio strategy. But they combine together because based on the characteristics of the markets, we set up the strategy. And also for the market efficiency, we have some implications. We can base on the implication of the market efficiency and go back to build a strategy to invest. For the final exam, first, I give you one market already about the Vietnamese stock market. With the Vietnamese stock market, think about the strategies you invest. So you have to learn by yourself what you think about that market, okay? And what you have on your hand, what you don't have, you set up a strategy. And another question, I may create the virtual markets, not Vietnamese stock markets, and I provide you some characteristics of that market. Based on that, you propose those strategy to invest. Okay, so this one, I'm sorry that I talk a lot without asking you the question because two topics they go really together. So just go by the flow. And now stop on this one and please ask me any question that you have. Or any points you want me to be clear? Any questions so far? To everyone? Excuse me? Where are you? Yes, do you have any question? I thought that's only Anton. Yes.
My question is about the belief of the investor. So, but the belief that the market is efficient or inefficient, or is in which form, weak, semi-strong, or strong, is just a belief of investor. There's no right or wrong way to define.
First of all, now in practice, I mean that the belief here comes from the evidence. Like they did research and they found the evidence to prove that the market is efficient or not. That explains to you why. For example, I do not criticize your belief. I just base on your belief and criticize the strategy you apply. But in practice, belief here just means we need to base on the evidence.